Information presented in this program is for educational and informational purposes only and should not be considered financial, investment, legal, tax, or professional advice. Any opinions expressed by the host or guests are their own and do not necessarily reflect the views of the producers, sponsors, or affiliated organizations. Digital assets, cryptocurrencies, decentralized finance protocols, and related technologies involve significant risk, including the potential loss of capital. Viewers should conduct their own research and consult qualified professional advisors before making any financial decisions.
Of TezTalks DeFi. Today we have James Bennett, the founder and CEO of StableMint here. James Bennett, kindly please introduce yourself, your background, and briefly what StableMint is.
Hi, Anthony. Thank you so much for having me on today. Delighted to be here. So StableMint is a vertically integrated payments company. We combine fiat payments and stablecoin payments side by side in a single account. We're based out of Malta. We're backed by CoinShares and work very closely with the Tezos Foundation, predominantly leveraging the Etherlink network as our core blockchain for our stablecoin operations.
Amazing, really glad that we're working together and have StableMint on the Tezos blockchain. Maybe we can also go deeper into your background before we dive into StableMint. What got you started with crypto, and what got you to start StableMint?
Yeah, good question. I've been in digital assets now since 2017, so coming up to 9 years. Time really flies. I started my career at GE, General Electric, doing a finance management program. So traveling around the world to different businesses. You can think of it like a management consultant specializing in finance. As with a lot of these, grad courses, you learn very aggressively. You're put in situations where, quite frankly, you're massively underqualified to be dealing in those areas. But it means you have to learn quickly. Through that experience, traveling to different businesses and with operations across many different countries. I think GE, was operating across more than 100 different countries. And when you're working in finance, you realize there's a lot of problems in the payments. There's problems paying suppliers. There's problems receiving money from your customers, especially when you go to Latam or Sub-Saharan Africa. Payments could honestly take weeks to actually reach us. So when I saw digital assets in 2017, it wasn't the first time I'd come across them, digital assets, but starting to actually see the peer-to-peer nature of Bitcoin. I mean, at the time, stablecoins were a thing, but they weren't really the kind of killer app. It was all about Bitcoin as a decentralized distributed network that was, able to be accessed peer-to-peer or sent peer-to-peer. And it just piqued my interest. This was an industry that was growing aggressively in 2017, not just the asset price, but also the activity. So I started looking into it more and decided to leave GE and move into digital assets and started a consultancy with a friend of mine, Max Englund. And we set up a consultancy in the UK as well as a sort of hold your hand brokerage. And the idea behind the consultancy was really to bring digital assets and blockchain applications into real world use cases and problems. It's been a kind of consistent theme for me over the last 9 years. I'm not in digital assets because I'm excited about, making 1000x on a meme coin. I'm here because I think the technology is genuinely transformative in applications predominantly centered around financial services. But in practice, over the years, we've struggled to really see that until stablecoins came along. So from that consultancy, fast forward to 2021, and I moved to a gold token issuance business out of Switzerland. Again, real world assets, physical gold on the blockchain. The asset's called DGLD, backed by some big companies across digital assets and gold. And they're similar thing, trying to really bring real world value onto blockchains. So then, bringing gold on chain, it's a more efficient form to use it as a collateral asset to borrow against. It's tradable 24/7, 365. It's portable. You can send it, ownership anywhere in the world. And I'll be honest, like, it was a great business. It still exists today, but it didn't make money. And people weren't. It was the right product at the wrong time. I still believe that. So you look at gold tokens today; they're starting to do a bit more volume. Nothing on the scale of the traditional gold market, but starting to kind of be recognized and useful as trading instruments, and volumes picking up significantly. So yeah, I spent a couple of years doing that, and ultimately stepped away because we as a group, so backed by CoinShares, recognized the incoming MiCA qualification in Europe, where stablecoins, which obviously had grown really fast, were now going to be fully regulated EU-wide. And that's an exciting opportunity, especially on that thesis of bringing real-world value derived on blockchains to various different industries, because now this digital asset could be recognized by corporates, by institutions, by fund managers as if it was cash on their balance sheet. So yeah, we grabbed that with both hands and decided to go after issuing stablecoin, getting the MiCA license. We set up in Malta, and fast forward to a couple of years later today, we've done about $180 million on chain settled in the last sort of 4 to 5 months, 500,000 transactions across thousands of wallets. And our AUM is still relatively modest, I'd say, but growing. And again, and we'll go into it in more detail in the through this conversation. StableMint is very much looking at Web2, TradFi, use cases, and bringing our stablecoin into those environments, as opposed to the sort of speculative crypto trading part of the market. So yeah, that's sort of where we're at today. And like I said, I'm sure we'll go into it in a bit more detail as we get through the conversation.
Yeah, amazing. And actually, like, to briefly talk about tokenized gold, just a week ago in Singapore, DBS has started issuing tokenized gold or providing tokenized gold as an investment alternative, on the digital asset platform. So I think you're right. Like a lot of RWA and stablecoins, they are fairly early, especially when you join and when you are getting into them. But now I think we are at a point where it's getting full-fledged adoption and proper regulations around it. So businesses, real-world consumers can actually start to use these. And yeah, maybe to shed light on StableMint, how is StableMint tackling the stablecoin market differently compared to, let's say, the other stablecoin issuers? Yeah.
Yeah, it's a good question. So, I mean, when we came into this, originally we had a big distribution partner that was going to support us in the crypto market. And the reality was that that deal, I can't name them, but a very large exchange, and that deal didn't go ahead. So we then, really had to double down on finding product market fit for a stablecoin in what I would consider a quite saturated market, like in that they're already, between Tether and Circle, they really dominate the industry. You had PayPal coming in about a year ago, a few other European stablecoins I won't name since they're competitors, and so we really took a step back to try and identify the different markets and use cases where we thought we could be competitive with a stablecoin, but not competitive against other stablecoins, but competitive against existing banking channels or certain regulations in certain markets that we saw an opportunity to sort of compete there. So yeah, that's how we sort of tackled it a bit differently. I mean, I can give you an example if you like. So, I mean, it's when it comes to so the kind of core thesis of what we do now at StableMint, relies on the fact that in different geographies worldwide, we have fantastic, in most cases, faster payment systems locally. So I'm from the UK. There we've got FPS, faster payment system. You can send a payment and receive a payment in seconds. Across the whole of Europe, we've got something called SEPA Instant that's now mandated. Every single bank in Europe, every credit institution has to be able to receive and send payments in less than 9 seconds. So that's, pretty much instant. You go across to emerging markets like India, you've got UPI, in Brazil, you've got PIX. And you see this pattern, all over the world. I'm sure there's something in Singapore, like locally. But when it comes to connecting those different payment systems, we've got nothing. There is really no global unified standard. Everyone's has a different operating system, and they don't talk to each other. And so that's where stablecoins, really, really sort of solve problems. So a good example is a client in Chile, where they have CLP. They've got their own faster payment system, and so they can collect CLP from their customers seamlessly. But then when it comes to getting CLP into euros and back to their merchants in Europe, they currently have to go through the legacy banking system. They get charged around 1.2 to 1.5% on FX, and these are $1 million flows a month, right? So it's a huge margin that the banks are taking. And then it goes through the SWIFT system. So a series of Nostro and Vostro accounts with correspondent banks. And the end result is it can take up to 5 days and cost 1.5% to make a payment, plus a fixed, $25 charge. So it doesn't work for micropayments. Even for business payments, it's massively inefficient. If you think you've got, a payment of $5 million or $10 million on the move and it gets stuck for 5 days, and interest rate is 4.5% to 5% on UST bills, there's serious money that's being left on the table when that capital is trapped, moving between those different payment systems. So it's a problem, right? And now what StableMint does with a client in Chile, we work with them to receive their local currency, CLP, convert that into stablecoin with our local liquidity providers. So not banks, but FX partners. And then from there, we can instantly transfer that USD stablecoin or Euro stablecoin into Europe. I mean, it's digital, right? And with our technology and our infrastructure, we can instantly redeem that euro or dollar stablecoin into local fiat currency and then pay out. So it means what would previously take 5 days and cost 1.5% in FX now can be done in about 5 minutes or less and cost around 50 basis points. So it's a complete mindset shift when it comes to cross-border payments. And so, we much rather compete there than sort of as a trading pair on different exchanges. That being said, we recognize at the same time, in order for a stablecoin issuer and a specific stablecoin to be useful in those cross-border flows, it has to be liquid and essentially fungible across the digital asset ecosystem. Because otherwise we have to plug into liquidity in every single market individually. If we work with a large exchange, think your Krakens of this world, Binance, Kraken, and so on, they have, it's their business to support liquidity locally in all the markets in which they operate. So a listing on those exchanges then gives our customers access to the liquidity to our stablecoin against their local, fiat rails. And then you come to like the cross-chain stuff. Everyone's got their own preference. Obviously, we have our core operations on Etherlink, soon to be Tezos. What's the new name? New name?
Yeah.
Tezos X. Yeah, soon to be Tezos X. And then you've got Ethereum, where the bulk of value sort of exists. You've obviously got Tron, that's record sort of usage for stablecoins. And so you can't be siloed on a single network. You really need to be connected across multiple networks. So cross-chain, on-exchange, access to different assets and so on. And by bringing together then what we do, which is on the fiat to stablecoin to fiat, and issuing the stablecoin, and then the liquidity providers, whether that's exchanges, FX providers, and so on, the sort of layer zero on the cross-chain side, bringing those two parts together, then you really have a sort of end-to-end payment system where you can move money from anywhere to anywhere almost seamlessly. In a regulated, I should say, always under a regulated umbrella, right? And that's the big difference about when Mika came in, is now you have clear regulation about what a payment company has to do and what a stablecoin issuer has to do and what a stablecoin actually looks like under the hood, which is important when you're dealing with institutions and corporate clients moving millions, because they want to know when the money's in transit, what exposure do I have there?
Yeah, understand. Actually, yeah, maybe we can go back to the client that you have in Chile. Focusing more on the real world to on-chain side, on the within Chile, right? Does that mean you have to work with on-ramp provider there? And for the liquidity provision from real world to on-chain as well, is that within their own currency? Is that liquidity provided by you guys or by some third party?
Yeah, so we work with a range of different third-party liquidity providers. The reality is, as a startup, you want to make sure that you can be as effective as possible in those different local markets without going in too deep. What I mean by that is going in deep means actually getting a local license to open a bank account that we can actually do that ourselves. So, as these flows scale, we might decide, okay, now we want to really plant our flag in this jurisdiction, and we'll get the local license. And that's then where, you get into the kind of WISE model. But also you have to think about your balance sheet, right? And providing liquidity in all these different markets off your own balance sheet can be quite heavy. So ultimately, it's about selecting the best partners in different geographies, and encouraging them, to work with you, because if you do flow, they do flow, and everyone's a winner. So yeah.
Yeah, I think one thing which I appreciate stablecoins speed and cost, but I always felt like the on-ramping and off-ramping portions, they take too much fees in terms of spread and one-time fee as well. So as maybe for StableMint as a company, you're able to get preferential rates, but as an individual, on and off ramping, it has always been very expensive. It itself is 4 to 5%. Yeah.
Is that with card? So I agree. I mean, I think with cards, we've sort of been taken to the cleaners for years. I mean, even a 4 to 5% sounds generous. Some providers you're paying 8 or 9%, which if you're buying $100 of stablecoin it's insane. I mean, $10 on $100, but I think the instant banking or the pay by bank method, so where you're leveraging the local payment rails instead of the card networks, then you get slightly more competitive pricing. It's still expensive, but you'll get more competitive pricing.
Understood. Okay, and for you focusing on real world payments versus other stablecoin providers mostly still focusing on on-chain applications, I guess, do you see the uptake from these real world businesses to be growing at the moment, and at what pace? Like, how many businesses are you onboarding at the moment? And what's the feedback from, let's say, the existing businesses?
What's the what, sorry?
The feedback that you get.
When it comes to the cross-border settlement, honestly, it's like, this is too good to be true. What's the catch? I mean, you've got two different sort of types of customers. You've got the ones that are digital asset aware, that have been following the space, that know about stablecoins, real world asset tokenization. They understand how to do custody in a secure way and the different options available. And then you've got the kind of larger market of clients that are still using that Swift correspondent banking network that we talked about earlier. And so, the honest feedback from those is, this is too good to be true. What's the catch? Because they just don't understand that it's possible to do payments outside of the SWIFT system and to pay, 50, 60, even sort of 70% less as a payment fee than what they pay today. So the feedback's been really good. I mean, we're onboarding businesses rapidly at the moment. So, 3 or 4 new businesses a week. Our operations team is ultimately very sort of under a lot of pressure, but they're doing a great job. We're excited to continue expanding on that.
I see. Yeah, understood. And yeah, maybe we can go deeper into StableMint's USDM and EURSM. Maybe you can walk us through how the underlying structure of these stablecoins actually work. So, like, how are they backed? The legal structuring around MiCA compliant stablecoin.
Yes, very happy to bore you silly with that. No, joking aside, like I said, MiCA is very prescriptive about exactly what a regulated stablecoin in Europe should look like. So I can walk you through that. The core of it is that for every dollar or euro, we'll just talk about dollars, but it's the same. For every dollar that we have issued on chain, we need to have at least 102%. So we'll do $100, $102 of capital on our balance sheet against that specific issuance. So we have to be over collateralized at all times. That 102% essentially has to be held off our own balance sheet in a segregated account. And the significance of that is that if operationally the company, went bankrupt, those dollars that are backing that stablecoin are separate from the company estate, so that creditors don't get any claim on that, which obviously is very reassuring. And that's a significant change that you had with MiCA regulation, and it's nothing new in terms of an operating system. Electronic money institutions, EMIs, that have been around since 2008 was the first electronic money directive in Europe, operate in the same way. So it was a case of sort of applying that framework to stablecoins. So that's the first thing, 102% over collateralization. The second thing, dedicated safeguarding accounts. And then the third thing is the actual composition of the assets. So for every $100 that we hold, at least 30% of that has to be in T0. So that means same day settlement assets. So that's really cash held with a bank. And then another 70% can be in high quality liquid assets. And that can be the treasury's portion. So UST bills or European central bank issued debt has to be high quality, has to be highly liquid. So there it becomes, interestingly, a little bit more of a fund management business, trying to optimize your yield while obviously making sure that you're maintaining the liquidity in case that somebody comes to redeem those stable coins. In addition to that, two really important policies that are in place and scrutinized heavily by the regulator. One is the recovery plan and the other is the redemption plan. Now, a recovery plan essentially answers the question of what does StableMint do in case for some reason the dollar on an exchange or in the market loses its peg. So now a dollar is worth 0.97 dollar cents. And we've seen that before. We've seen it with every stablecoin in the market, in fact. And that's naturally going to happen in periods of stress in the market, because ultimately the price on the market is governed by supply and demand. And so if everyone's running for the exit because they lose faith in a stable coin or a Trump coin or whatever, the price will go down as everybody sells more than they buy. So we have to have a plan in place for that. And then we've got the redemption plan, which is if, again, for any reason, stablecoin was to wind down, how do we make sure under this regulated framework that every single token holder is made whole and has the ability to redeem at par that dollar. So for every dollar stablecoin, they get $1 back. So yeah, across the asset safeguarding and then the recovery and redemption plan, we have a very sort of strict set of procedures that we have to follow that are governed by the MFSA. We have internal audits. So the regulator essentially comes, and they did recently, and say, we want to understand your safeguarding policy or your recovery and redemption plan. You need to appoint an independent auditor to basically review that, share with us the results, and then from there they get a really good idea of exactly what's happening in our business, and can sort of oversee that accordingly.
Understood. Regarding the independent audits and attestation reports, how frequent are those required? I understand some RWA tokens have daily attestation reports or monthly. Yeah, just curious.
No, it's an interesting one. I mean, look, I think it's not massively practical to publish a daily attestation report on the reserves. I think that's been a really important practice prior to having an effective stablecoin regulation in Europe. But when you look at MiCA and all of these things I've mentioned today, as well as then quarterly reporting to the MFSA and financial audits, I don't think personally that it is helpful to kind of be publishing the state of those underlying reserves every day, because the regulatory framework covers that sort of security from the customer point of view. It would be a bit like going to a bank and asking for a live, real-time, statement of accounts of how their how their loan book looks against their borrowing, and making a decision on whether or not you think the bank is liquid or not. And that's what regulators are for. And as much as I kind of support what the DeFi, decentralized finance is trying to do, I think when it comes to being a regulated business, actually the whole point is that you're sitting within a well-trodden path, and there's a number of controls in place to ensure that things are properly overseen. So today we don't publish real-time attestations. We don't publish any today. That's not, obviously there's nothing to hide there, as I said, because of the regulatory framework. We don't have a choice to do funky things, but it's a technology problem, because we hold assets across a number of different banks, and so then you need to think about how do you get a real-time feed on the underlying value of those positions on an ongoing basis. And obviously, if there was one day an API went down with a certain bank, and remember that we're reliant on these banks to then use their APIs to get that information, then you might be in a position where your reserves misreport, and that could actually be a detriment to token holders, because then people would panic and say, well, StableMint has 30% less than what they attested to. But in reality, maybe that API feed went down, or there was a misreporting on the bank side. So yeah, I think it can cause more problems than it solves. I do think it's healthy to make it available on a monthly basis, and we're going to be doing that going forwards. But I suppose also, if our clients come to us and say, StableMint absolutely has to do this, or I'm not going to hold their stablecoin, then we'll have the conversation. But honestly, nobody's asked us yet.
Okay. Yeah, I think that question came more from I think a DeFi privilege that we have always had, constant on-chain data. And I previously when I spoke with Vault protocols, a lot of them were trying to replicate a level of on-chain data even for off-chain assets. Yeah. So yeah, just curious. But yeah, that's great. I think especially with the MiCA regulations now, there's much less to worry about. back when I first joined crypto, and when stablecoins were still innovating on fractional reserves, crypto reserves, a bunch of different mechanisms. Now I feel a lot more safe, even without daily attestations. Understanding how the MiCA regulations affects StableMint's reserves and how you guys operate, I think it's a good step ahead. And maybe going further into our partnership of glad that StableMint is deployed on Tezos X. Maybe we can dive deeper into why do you guys choose Tezos X, and how does it compare against let's say other blockchains that you guys are deployed on?
I think, there's some very obvious like headlines. Near zero fees obviously make transactions very very sort of seamless, especially because one of the ways that, as I mentioned, our client base is not crypto literate, and so they can't handle gas fees. Can't handle as in, then they'd have to set up a wallet, then they need to fund a wallet, then they need to make sure that those funds are available, and maintain a balance in those wallets and so on. So we abstract all of that away. We provide them the wallets, in a secure way, and we sponsor the transactions. So by having near zero fees, we can comfortably take care of that without it having a big hit on our P&L. Doing that on Ethereum, and you end up in a high gas environment because everybody's trying to do transactions at the same time, and you end up doing 1,000 transactions in a day. Your gas fees could be, I don't know, $20-50 a transaction. So there's a meaningful hit, and that would have to be passed on to the customer. And then all of a sudden, this picture that I described, where it's cheaper and faster, it's still faster, but actually it ends up not being much cheaper. So the near zero fees on Tezos X is absolutely paramount, and settlement times as well. Settlement times, make a significant difference. Sorry, I'm just going to. But ultimately, we want to be multi-chain, and so whilst we kind of put our core foundation on Tezos X, because of those things, we also have the privilege of being able to be a layer 0 token, and then accessing other EVM chains, and we can only do that because Tezos X are themselves working with the likes of layer 0 to make sure that their protocol is integrated, and that's where the team have done a fantastic job across the board, is recognizing that they can't be in a silo in order to support projects on the network. It really needs to be properly connected into the wider ecosystem, and so really happy with the way that the team approach that, sort of have that mindset. I think it's it's essential to sort of survive in this, let's call it the sort of the layer 2 wars that have been going on for a few years now.
And I think earlier on, I know you did mention a stronger focus on real world applications of StableMint's stablecoin, but you did mention liquidity being required within the on-chain segment as well. Maybe diving deeper into that, for StableMint's USDSM and EURSM, would there be ability for retail users like anyone on Etherlink, on Tezos X, to be providing liquidity to essentially help you guys out with the liquidity on chain and potentially earning an interest on that as well?
So we don't have any sort of DeFi products live with our stablecoin, unless you consider sort of Curve, so the decentralized exchange Curve. We are live on that, and we have pools across Tezos X, Ethereum, Base, and Arbitrum. And there you can deposit your stablecoin and then earn a share of the fees that come through the DEX. So that classic model as well as I think probably still LP tokens from Curve. I don't know exactly how it works today. But ultimately, I don't think that the yields are going to compete with what the DeFi native crowd are looking for. So it's something for us to think about. I mean, I don't know about you, Anthony, but I think if something seems too good to be true, it usually is. And I think that's what we've seen with liquidity farming, and especially these sort of algorithmic stablecoins, everything from the sort of WanderFi and obviously Terra Luna, and everything in between. That ultimately, you can't get something for nothing without it being, sort of very high risk. And so what I'm getting at is it's very difficult for the DeFi market to competitively improve on interest rates that you can get in banks without adding significant amount of risk on top of that. So like the idea that, I can get a better yield on chain than I can with my Revolut account, I just don't think that for me personally, and my sort of mental model is, I've never wanted to go after that, because I think that the risk you're taking is much greater than if you hold your funds in a Revolut account, and then to get an extra 2%, for me it's never been worth that. So yeah, I don't. Maybe this will change in the future, but I don't honestly see that we can compete in providing like on-chain yield for our stablecoin holders. I see them as a payment instrument, not so much as an investment or an investment instrument. I suppose in the long run, we would like to be able to offer people some yield so that they can stay on chain with all the benefits without having such an opportunity cost. I.e., losing out the full, let's say 3.5% on euro that you might get with your Revolut. But we're never going to be able to beat Revolut, on yield, and also sort of keep people's money safe and stand by it. So yeah, that's how I think about it today.
I think that's a refreshing view. I think having spoken with Vault protocols, they are still fairly obsessed with trying to optimize on-chain use and keeping it safe at the same time. But it is unrealistic, given that just to benefit from an extra 1% to 2%, we are potentially having to lose the whole bag. I think that has become fairly apparent with the recent exploits that DeFi has faced, and the on-chain use are not worth farming.
Yeah, and I don't know about you, but you look at like Anthropic's latest Fable model and the Project Glasswing, and the power of this thing is like, I feel less and less confident in, especially when it comes to money that has that's now a bearer asset as a digital asset. Like if you get defrauded by your bank, especially if it's via your credit card, the credit card programs or the card issuers bear that liability, and actually, in a lot of cases will refund you. They'll cover that fraud risk, and it's priced into the model. As you know well, I mean, in digital assets, if you get hacked or defrauded, the money's gone. There's nobody to call on. There really isn't. Sure, with stablecoins you could freeze them, but nobody's coming after that for your personal life savings, probably. Because there's so much going on at all times that it's going to be very difficult for that to be recovered. So, yeah, I think the ideology and the reality are still very far apart, and we're slowly moving towards that fully. We're making progress, but I don't see currently in the horizon a world where people can feel as confident holding those funds on chain in liquidity pools. Yeah.
Totally agree. And maybe going into current adoption for USDSM and EURSM on the individual and business level. Maybe we can share some broader strokes on what sectors are adopting stablecoin at the moment, and what are the main use cases being driven right now.
Yeah, so it's really the cross-border segment is significant for us. We have a kind of core So we've got three different products. So we've got a checkout, we've got business accounts, so merchant accounts, and then we've also got at the moment we've got individual accounts. Now, the individual accounts we may consider winding down. We're sort of assessing that at the moment, only because we need to make sure that if we're going to be in a segment, in a vertical, we want to be able to compete. And we're seeing so much traction on the business side that we really want to double down on that. So I'll speak to the business and the checkout. So yeah, on the business side, we've got the cross-border payments, as well as your sort of typical business bank account, where you can have your fiat and stablecoins side by side. So we see payouts being made in our stablecoin. We see payouts being made in fiat, and you can do third party transfers, so to your own name or to a sort of another account, paying suppliers, paying employees, paying sort of marketing companies, whoever. Then the other part we have is the checkout, and the checkout is a business product. It's a way for our customers, so e-commerce businesses, to be able to this is really cool, right? They're able to collect fiat locally in the markets in which they operate. So Europe being a big one, Sweden and some others. They collect those funds locally in fiat currency, and as soon as we receive the payment from their end customer, we convert that into stablecoin and we settle that with the business in stablecoin. So they don't have to deal with crossing between different payment networks. If it's from euro into USD or SEK into euro, across those different payment networks, we handle that through the on-chain stablecoin side. And the whole flow, whether it's from the individual going to the checkout or it's the business receiving in their account, nobody sees a stablecoin. We operate everything under the hood. And so, yeah, we've seen quite a lot of adoption for that product, as well as the sort of classic business accounts. Yeah.
Yeah, that's amazing. Actually on this right now, like in terms of competition, I understand major providers like Stripe are also looking into this space. I guess in these areas, well, does StableMint have core advantages against major players coming into the space for payments?
Yeah, I mean, payments is one, it's an enormous space, and two, it's very highly competitive, right? So there's a lot of, the pie is large, but there's a lot of hungry businesses trying to take their share. So yeah, of course we have competitors. I mean, how we differentiate ourselves is being vertically integrated end to end. So that means that we have the checkout product, so we can actually do a custom embedded checkout either through an API integration or an actual widget in someone's website that can be white labeled to their brand colors, and we collect the payment. So that's kind of where the Stripe element is. They're great in that segment. We have pay by bank transfer, and cards. Then when the funds settle, we have the payment accounts side by side, fiat and stablecoin. And again, then today, I think Stripe don't offer that, so they'd allow you to do the checkout, and then they'd settle you probably in one or the other. And so then we offer those business accounts to hold those funds. Then you've got the payouts, right? So now I've got a business account and I need to pay those suppliers and those employees, and so you can manage that as well from your dashboard. The final thing is that the stable coins we use in that flow, we issue them ourselves, and that has some advantages in that obviously we can manage the underlying collateral. We also have the ability to spin up different currencies based on client demand. So today we do euro and USD. If we want to do GBP, CHF, Hong Kong dollar, name a currency, we can look at adding them relatively easily. Whereas your kind of traditional payment infrastructure providers, they either sit in, they sit in different parts of the stack, and then they kind of tie together different services or solutions in order to, serve a particular business customer. So you've got fragmented licenses, you've got different providers, each with different compliance requirements, and ultimately each taking a share, a fee. So yeah, I think we can be more competitive on pricing. We offer, in some ways, more features, but for a very specific type of client, and it all sitting under one single license. And today, I don't see anyone that does exactly what we do, but there are obviously fantastic payment companies that we admire, from your Stripes to your Bridge, and I guess you can kind of consider them the same now, in fact. And then BVNK is another one, built by MasterCard recently. But those guys, mostly doing orchestration as opposed to offering the full service sort of payment account.
Understood. Yeah. So StableMint sort of offers full suite of services for businesses, and they essentially will never have to even know that they are utilizing a stable coin. I think that's great. Maybe you can also give us a peek into what we can expect from StableMint in the coming upcoming quarters. Maybe deeper integrations, more chains, like any new features that you can share with us.
Yeah, absolutely. So a couple of things I'm really excited about. We have a listing on Kraken coming next month, and that's going to be native on TezTalks, which is fantastic. We've also then got, on the product side, a couple of things I'm excited about. We want to add cards to our business account so that our customers can pay with their stablecoins via a Visa or MasterCard. That's a big one. Always looking to upgrade our back office to kind of support our customers with their back office. So it's pretty boring stuff, but actually it matters. Integrations with accounting softwares and things like that. And then in terms of adding chains, at the moment we're very happy with those chains that we're sitting on. Unless it's very much sort of driven by customer, then I don't see us sort of going further at this point. But definitely adding currencies, fiat currencies, to our offering, so that we can continue to support in the cross-border payment side. So I think if we speak in 6 months, we'll also be supporting Argentinian currencies in Argentina, in Brazil. Those are really exciting markets for us, as well as in Chile, and then also looking towards sub-Saharan Africa, and just repeating that model wherever we can. So there's a lot coming up.
That's great. And excited for card issuance through StableMint as well, and more currencies. That's even greater total addressable market. And maybe I can get a view as well on the future of regulated stablecoins. Where do you see that space headed in the next few years? Because I was looking, when you mentioned MiCA compliance and having to have 102% over collateralization, I understand that it's a consumer protection feature, but would that potentially wind down lower in the near future, where we have other safeguards in place, given the over collateralization feels like feels inefficient. Yeah.
Mm. So the question is whether the future of regulated stablecoins, if I think
in general, your view of regulated stablecoins in the coming years, and a more specific question on the collateralization. Do you think that stays at 102%, or does it drop down?
Oh, I think it has to. I'm actually surprised it's not higher. If you look at regulation on banks, where I think they need to hold around 30% in equity, on their balance sheet. So essentially over collateralization, and I don't think they can even do anything with that. Don't quote me on that percentage, but it might even be higher. But it's a significant part of tied up capital, and they were encouraged, no, told, required to do that in the fallout of the 2008 financial crisis. And so, I think that 102% is reasonable, given that ultimately this is people's money that we're dealing with, and we need to ensure that all stablecoin issuers do retain or continue to be fully solvent and reliable. Otherwise, the whole thing, would break down, and that's what the regulation is for. So, I'm happy with how that is. And in terms of regulated stablecoins, I mean, it's I don't think it's going to be difficult to not be a regulated stablecoin in the coming years. Obviously, there's a lot of markets, the offshore markets. Again, certain regions of LATAM and Africa and the sort of Caribbean islands, and maybe in Southeast Asia, where you see a lot of Tether, USDT, notoriously not a MiCA regulated stablecoin, not under the is it the Genius or the Stable Act in the US, but they did launch a sort of compliant stablecoin, but I don't think it's done particularly well, because their real business is in USDT. So I think that you're going to struggle significantly to be able to operate where the money is without being inside a regulatory perimeter. And I think the regulatory perimeter is expanding. Europe's gone first, US is following. I think Hong Kong, it's have now a framework in place. You've got the likes of the UK bringing in sort of stablecoin regulations, I think next year. And so the space is, the available market for being non-regulated is going to continue shrinking. And it's good. I mean, look, the reason that the space is growing so fast is because of the regulation, in my view. Because now, if you're a multinational corporation and you're doing these cross-border flows, you have an alternative to banks that give you the same reassurance that those assets, are going to be solvent during the period that you're holding them, and that they're going to maintain their peg. And that confidence, in my opinion, comes through regulation. Maybe not for the DeFi crowd, but for those incumbents that are operating these companies, the treasurers, the CFOs, that are ultimately responsible for the secure sort of holding and transfer of the money. That's what they look for. They're looking for that rubber stamp from a regulator to make sure that that asset is reliable. So, I think the future is regulated stablecoins as opposed to sort of unregulated. And I think that, the regulatory perimeter will continue to expand globally.
Understood. Okay. Yeah, and just a random question I got I got in my head. Would there ever be a government issued stablecoin that comes into play as well?
There are many. I mean, that would be your CBDCs. So, I try to stay out of that conversation a little bit because I'll be honest, I'm not massively well informed. There's so much going on. I mean, there have been 50 or 60 pilots for CBDCs
in
already. No, globally. So,
okay.
It was I think it was the Bahamas that started with it in 2015 and had some success there, but very small economy. But I don't see that we're going to have a major market CBDC sort of in the West, if you like. Well, China's had a lot of success with theirs as well, but again, I don't know enough about it. I think the contradiction I see with a CBDC locally in the retail segment is that, as we've said earlier, the local regional payment systems that exist today, they work incredibly well. I can send money from across the whole of Europe or across the whole of the UK or across the whole of the US near instantly, for a fraction of a cent or a few cents. So I don't see how a CBDC improves upon that. I think it just creates a more embedded control structure for the government to sort of to meddle, influence people's personal finances, which I don't think is a good thing. And I think there'll be a lot of backlash from individuals if that's the case.
Yeah, I agree. But yeah, actually, yeah, we can cut this out of the pod. But in Singapore, we do have digitally issued sort of like stimulus now. So yeah, individuals get maybe, let's say for myself, for this year, we get $600 to spend specifically on groceries and supported merchants.
Wow.
And you can only scan your QR code and pay directly to those merchants with those vouchers. So it's sort of like targeted stimulus. Yeah, which is fairly interesting.
They've like whitelisted certain providers, and
Yes. Yeah. I mean, I think it's smart because previously when we saw COVID hit in the US, they were giving out I think $1,002 per week for unemployed people, and end up most of the money that was given to individuals went to the stock market or to gambling.
Yeah.
So I guess in this niche use case, I mean I'm not for government issued stablecoin, but I am interested in exploring the in between, the spectrum, I guess, where digitally issued money in certain cases.
Absolutely. I mean, I struggle to speak sort of very eloquently about Southeast Asia because I just don't know the market. You know,
It's too fragmented. Don't worry about it.
Yeah.
Everyone's just doing their own thing.
Yeah, right.
But yeah, it's been great to learn about StableMint, the MiCA compliance behind USDSM and EURSM. Having you guys deploy on Etherlink, we really appreciate the collaboration that we have here, and excited to see StableMint expand deeper into the real world use cases and various use cases that you guys are already tapping on. And having to connect the on-chain world with real-world payments to support cross-border remittances and payments, I think that's a really good use case that hasn't really been fully expanded on. And StableMint is at the frontier of this.
Yeah, absolutely. Well, thank you very much.
No worries. And maybe for yourself, if you got any final words for the audience.
No, not really. I mean, I think if you don't know about stablecoins yet today, then I would strongly suggest sort of looking into them. If you want to kind of dig into some of the things that we do, then you can visit stablemint.io, and we'll have some use cases on there, as well as some blog articles to get a bit of a deeper dive in some of the things that I've talked about today. I just strongly encourage you to find out more, because in 10 years' time, I don't think we'll be operating. We won't have wallets that don't already integrate with stablecoins in some way.
Yeah, that's great. And thank you for your time, James. And that's all for today.
Great. It's a pleasure. Thank you.